Well, greetings, test takers. This is Dean Tinney. I'm coming to you from my studio here in fabulous Las Vegas. This is a follow-up lecture on suitability. We did the first part called Suitability in 60 Minutes. It's in the Series 7 playlist as of today. It's not in the SIE and the 65 playlist, even though I think it may be appropriate. I didn't put it there as of today because I might be a little too much. You might find it there later, but if you're watching the second lecture, suitability, yes or no, or more suitability or less suitability, you can find that if you want to as an SIE candidate or Series 65 candidate in the 7 playlist if you don't find it in your series playlist. That first suitability in 60 minutes was starting with the investments and then looking at the benefits of that investment, whether it be income or capital appreciation, whatever the case may be. In this follow-up, our second part, we're going to do it from the opposite direction. So that was about investments and products, and then the client that would match. And this, we're going to do it the other way. We're going to start with the client and the products that match. So this is not about the product. It's more about the investment objective first. So let's get started. Let me get the screen up and we'll get going. So as you can see here, what we're doing is the investment objectives and goals of the customer, and then talking about what would be an appropriate investment vehicle, which might not be an appropriate investment vehicle, more appropriate or less appropriate, or is the, title says yes or no, suitable yes or no. So if the customer's investment objective, now everybody's a little different. What I used to do when I was a practitioner is say, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10, 10 being very important, 1 not important at all. Now, preservation of capital, 10. So what might we recommend? We might recommend money markets or money market funds or money market instruments, high quality debt maturing less than 12 months. We might recommend government securities. There's no better credit quality than that of the United States government. And so in a T-note or T-bond, you don't have credit risk. You're only going to have interest rate risk. T-bills, you don't even have interest rate risk because whatever interest rates are doing, that's what you're going to be doing. We might recommend Ginnie Maes. Ginnie Maes have the full faith and credit of the United States government. The other government-sponsored enterprises, Fannie Mae, Freddie Mac, and have implied backing. Not quite as good, but it's still good. And so those would be some things, some arrows in our quiver, so to speak, for the client who says preservation of capital is important to them. Now, what would be less appropriate or not suitable would be stocks, equities, or partnerships. I can't imagine any draw of Series 7, certainly, but SIE and 65 as well, in which you don't get tested on lack of liquidity or lack of safety as it relates to oil and gas, for example, direct participation group programs, partnerships. Okay, so I say I'd like to read you a list of investment objectives, like you to rate them on a scale of 1 to 10, 1 being not important at all, 10 being very important. You tell me current income, 10. Well, I say if current income is what you need, then we got several investment vehicles that will do that. We've got government securities. We have municipal securities. These are debt securities, right? Paying interest. So we have government agencies. Now, Ginnie Mae, if we need monthly income, that would be a good recommendation because Ginnie Mae's is the only debt instrument we have that pays interest and principal monthly. We might make a recommendation for preferred stock that pays a fixed dividend quarterly, or a dividend paying common stock, for example, a utility, which if it pays quarterly as well, or an income-oriented mutual funds. We're less likely to recommend equities in which there is no dividend. The only 2 ways you're going to make money in an investment is the income stream and or price appreciation. And so if that investment has no income stream, like a common stock without a dividend, the only way you're going to make money is to sell it to someone else for more than or less than you originally, bought it for. Direct participation programs are kind of backwards. Direct participation programs more about a return of your capital first, then a return on. So a little different. All right, so you say capital growth at 10. I say investment objectives 1 to 10, 10 being very important. We would recommend a common stock or a common stock mutual fund. we're less likely to recommend debt securities of any sort. I say 1 to 10, 10 being very important, 1 not important at all. I say tax advantage. And you say tax advantage, ooh, 10. Tax advantage, tax favorite. I say, well, have we funded all your retirement plans? There's a huge tax advantage in funding retirement plans of all types. You say, yeah, Dean, I've taken care of my IRAs, my other retirement plans for my employer, and I still wish I had more money that I could set aside on a tax deferred basis. I said, well, hey, variable annuities would do that for you. You say, Dean, I've got retirement taken care of. What I'm really getting crunched with is tax. I've been pretty blessed. I'm in a very high income tax bracket. And then we would recommend tax-free interest, municipal bonds. I can't imagine you're not going to at least get one question where they tell you somebody's in a very high tax bracket, uncomfortable, whatever the case may be. They might even give you the bracket and you got to do tax and tax-free equivalent yields. There is no tax favored treatment for those corporate securities we're discussing. Those are going to be fully taxable. Diversification. Bernard Baruch, legendary Wall Street speculator, said money is like manure and you ought to spread it around. So the easiest way to avoid non-systematic risk or selection risk is through diversification. And so, to avoid that, we're going to buy multiple securities or types of securities. And the easiest way for most retail investors to get that done is in the context of a mutual fund. Now, the fewer securities, or the less the diversification of the portfolio, the more we're going to be exposed to selection or non-systematic risk. Keeping pace with inflation. So common stock is definitely a good hedge against inflation, or what's called purchasing power risk. I hate that we always are talking about as, test prep vendor providers, variable annuities, but variable annuities is only in the context of, being compared to a fixed annuity. I would also, let me get on my annotation tool, and I would definitely add to this discussion of keeping pace with inflation besides common stocks. I can't imagine you're not going to get common stocks, but you might also get TIPS, Treasury Inflation Protected Securities, is being a recommendation for a customer who wants to keep pace with inflation or is worried about purchasing power risk. Liquidity. How quick can I turn my money, my investment back into money? I mean, the idea is we're going to turn the money into the investment, and at some point we're going to turn the investment back into money. And how quick can we do that? Well, as a money market fund, right? Money market instrument itself, very liquid, or the fund itself, very liquid, redemption within 7 calendar days. Listed securities, NASDAQ, New York, if they're listed, those are their market centers, T+2. A mutual fund, as we said, 7 calendar days at the next calculation of NAV. And there's going to be less liquidity in thinly traded securities. Thinly traded securities have bigger spreads. So, there's going to be a bigger difference between the bid and the ask on a thinly traded securities. In a direct participation program, you see this is in the column of less likely or not suitable. In a direct participation program, also known as a partnership, you can't get in or out of the partnership without the permission of the general partner. I can't imagine any exam in which, again, this idea of lack of liquidity in a partnership doesn't come up. And then annuities are not liquid as well. I mean, you should be able to fund the annuity and have that money, deployed until you're 59 and a half in a variable annuity. So speculation, derivatives, if you want to speculate. So I said, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10, 10 being very important, 1 not important at all. Speculation, you say 10. I say, well, good news. We have options. We can buy calls and puts, and if we're foolish, we can sell calls and puts. We can go long futures or short futures. I wouldn't worry about futures as it relates to Series 7 or SIE. There are a couple future questions on 65, and I'll at some point put up some practice questions in the Series 3 playlist for futures. Sector funds, I would know they're diversified, but only within their sector or region. So if it's a tech fund, for example, it's only diversified into the tech sector. Or if it's a regional fund like the Mexico fund, it's only diversified within Mexico. So those are a little more speculative than, your plain vanilla type of a mutual fund. And you don't speculate with government securities. Remember, the opposite of speculation would be safety. That's another way to approach these kind of questions, by the way. And I would warn you that a lot of times they don't ask you to recognize what is suitable, because you can see here there are more than one in each of these categories, more than one investment vehicle that is suitable. And there could be less of a consensus on that. And so what we usually do is ask you to recognize something clearly unsuitable given somebody's investment objectives. There's a lot more consensus on that. Leverage. You say, Dean, I want to make my little money do a lot. I want to make my little money do a lot. In a margin account, you can use half of the money, right? You're going to be making in a margin account money twice as fast, and you're also going to be losing money twice as fast. So leverage option accounts provide tremendous leverage. If I buy a 160 call at 6 and the stock's 172, my contract is now worth 12. I've doubled my money. Same idea, basically. Same supercharged speed we're going to be making money with is the same supercharged speed we're going to be losing money with. Again, less leverage or no leverage would be a cash account where I intend to pay in full. So what are we investing for in terms of time horizon? Well, that's very important. I mean, time horizon is huge. The difference in tragedy and comedy is timing. I always joke, if there were just an act 6, scene 1, everybody on the stage would still be alive. Instead, tragedies have act 5, scene 5, with everybody having tragic consequences. So if your time horizon is shorter, we're going to make different investment decisions about suitability than if your time horizon is longer. So if it's a short-term horizon, it comes up a lot on the exams. They have questions like, somebody's being relocated from work. They've sold their place in California. They're, retiring to Nevada. They're going to rent until they find a house to buy, something like that, that gives the context of, gee, this is going to be money that needs to be available within the next 6, 12 months or so. And money market certainly meets that bill. That's the one they're usually looking for. And then liquid securities, we said, whether it's a money market security or whatever that security happens to be, I'd be looking for, as a test taker, money market being the answer. Here, shorter term debt, again, maybe a CD is offered to us, maybe a CD that fits the time horizon of whatever this customer's situation is. Less suitable would be longer term debt or illiquid securities that we've discussed. Now, if you have a longer time horizon, well, then we can be, approach getting you to your financial destination. I kind of think of your time horizon being your financial destination. Your financial destination, 15 years from now for retirement, or 5 years from now, what is that, time horizon? I always thought it was a big turn on to be able to call our customer and say, listen, we've arrived at our financial destination. You now have enough money working for you. You don't need to work for your money any longer. So with a longer term horizon, we can have longer term debt. We can get exposed to some growth oriented equities, thinking over the long term, this will work out. And then again, less suitable would be shorter term or being liquid. I mean, there's an opportunity cost of being liquid. And so we're saying here, we're not going to give up the opportunity cost by being liquid. We're going to go ahead and say, okay, let's go for some opportunities that are longer time frames, but hopefully pay us some more money. So these are other current and future needs factors that can include your age, your marital status, your number of dependents, their ages. Again, that the obvious thing here would be college education, 529s, Coverdales that we talked about in our previous suitability lecture. Their employment status, are they self-employed, or they have a reliable kind of a job, and what is the retirement plan they have access to through their employer? Is it a 401k? Is it defined benefit? Is it defined contribution? Whatever the case may be. All right, so risk types and tolerances. More so capital risk. They say, Dean, I'm comfortable that I could lose all of my money. I said, well, that's easy to do in options. I'm joking, right? At expiration, if you own an option contract and it has no intrinsic value, it's going to expire worthless. So it's pretty easy to qualify somebody who wants to buy an option position. This is money you can afford to lose. Capital risk, the risk of losing all one's investments, It's not likely you're going to lose your investment in government securities or money market securities. So again, more or less, yes, no is kind of what we're doing in this version or follow-up to suitability in 60 minutes. Inflation risk, very important, AKA also known as purchasing power risk. And very important to know that you get exposed to this in debt securities and fixed annuities. That's very important, very testable. The fixed income securities aren't going to do so well. And then you're going to have less exposure. Remember, this means if you're worried about inflationary risk, you shouldn't be buying debt and fixed annuities. You should be buying equities and variable annuities, again, as compared to the fixed. The timing risk, instead of buying low and selling high, you continually sell high and buy low. So poor timing risk is the risk of, doing this in the opposite direction. And again, that's you're more exposed to that if you're doing frequent or short-term trading. You're less exposed to that if you do like buy and hold. You're more exposed to this if you're tactical, frequent and short-term trading versus strategic, less frequent trading. Interest rate risk. I can't imagine you're not going to get tormented on this. I always tease, if anybody ever asks you about economics, finance, or investments, and you want to sound smart, say it has a lot to do with interest rates. And if you just shut up, you sound pretty good. You say, well, what about them? You say they fluctuate. They go up, they go down. And so when interest rates go up, fixed income investments, debt instruments, and preferred stocks are going down. You're less exposed to that in common stock. Reinvestment risk, the risk that reinvesting the proceeds from redemptions, bonds mature, and you say, just give me another one like that. I said, well, I don't know where you've been. Interest rates are no longer paying that. In the 80s, you could get a treasury bond that paid 18%. It now matures. You say, go give me another treasury paying 18%. I go, well, I know where you've been, but we can't do that. That's associated, very testable with falling interest rate environments. And in a falling interest rate environment, it's very likely that the issuer is going to call the bonds. Now, from our previous suitability lecture, remember, we do have investments where you don't have to worry about this. It's reinvestment risk, the proceeds. You're always going to be exposed to that even in a zero, but you're also exposed to that through the semi-annual payments you're receiving. Again, you're not going to have this with rising interest rate environments because you're going to be able to reinvest at whatever that rate happens to be. So it's not, you're going to be able to invest at a higher rate. So remember the right column less is the opposite. Call risk. Yeah, this again is associated with falling interest rate environments. And when that happens, remember, once the bonds have passed their call protection period, they can be called. So you're not going to get called away when in a rising interest rate environment. It's in a falling interest rate environment. And I would definitely know from our previous suitability lecture that zero coupon bonds are non-callable, treasury notes and treasury bonds are non-callable. So that would be one way to eliminate call risk in terms of a debt instrument. Market risk, the tendency of securities prices to move together. So, again, also known as systematic risk. And the test question here, let me just get out my annotation tool, is, as you recall, I told you that you can eliminate or reduce substantially non-systematic risk or selection risk through diversification. But in these, let me get a smaller font, risk prevails despite your diversification. So, it'd be testable to know that, regardless of diversification here, prevails despite diversification. Crash course, the market drops 30%. I don't care what mutual fund you have, what portfolio you have, it's very likely that, it went down as well. Now, you might want to have some diversification where you're not exposed to market risk. And again, you couldn't be exposed to market risk if there is no market, right? If these securities are non-negotiable, non-marketable, non-negotiable, mean the same thing. There is no secondary market. So a CD, for example, wouldn't have that risk because it's not trading. Credit risk, very important. On the test, we said in debt instruments, the credit risk is associated with default, or here it says financial risk, but it's really default. And I would know that less than BBB is less than investment grade. And, maybe on purpose, I'm diversifying you by credit quality to get your yield up. So credit risk is associated, by the way, and the two major risks in debt instruments are credit risk and interest rate risk. Credit risk and interest rate risk. Liquidity risk, we talked about that already. Let me just, I just don't like this you know, if I was going to redo this thing, I'm not, but I just want to get rid of this here because that's really not the point. It's not about credit risk is not about stocks. It's about default. And, you know, boom. And again, that's associated with fixed income investment vehicles. Credit risk and interest rates are the two biggest risks in fixed income investment vehicles. When you're lending your money, right? They don't pay you, default, or, you know, you have interest rates go up and the bond price goes down. Liquidity risk, we talked about this. This one on the other side is what's testable. So we talked about what are, you know, products that can be turned back into money quickly, but the test questions are the opposite about products that cannot be turned back into money quickly. And we said it's very testable. No, that's true of direct participation programs known as partnerships, right? Because you can't get in or out of a direct participation program, a partnership, without, you know, approval of the general partner. All right, our last one here for the second part of our suitability, where we're talking about not so much the investments, but the client and then the risks that those clients might be exposed to. Legislative risk is anytime Congress is in session. I'm joking, but, you know, Senator Roth is not here to defend his Roth IRA. There are substantial tax benefits in that. There are substantial tax benefits in municipal bonds. There are substantial tax benefits in life insurance. I'm kind of just giving you a laundry list here of things that have exposure to legislative risk. What Congress giveth, Congress can taketh away. Oh, for example, the dividend exclusion ratio used to be a 70%, but Congress changed that, and now it is 50%. So any kind of, you know, tax situation can be changed. Congress has been talking about changing LIFO share identification or average cost share identification, or FIFO, from elect you choose to mandatory FIFO. That's been on the agenda now last 3-4 years. Ooh. And that would be bringing billions of dollars to the Treasury. And so that's called legislative risk when they change the rules. Okay, so I hope you found these two suitabilities. It's a request that we get a lot to have more suitability content on the channel. And so this will be going up with the channel. And this is, again, the second part of Suitability in 60 Minutes. It will go into the Series 7 playlist. It will go into the Series SIE playlist and the 65 playlist as well. If you don't find the first part of this lecture, Suitability in 60 Minutes, again, SIE 65s, you can find that in the Series 7 playlist. Again, like, share, subscribe. Give me your recommendations for any kind of content you'd like to see on the channel, and we'll get it up there for you. Thank you.